Hey, welcome back. Glad to be back for another session. We're going to jump in this week and try to give you some understanding of just how the funds work, but also a little bit about the account codes and how you can have a better understanding of the overall picture of what's going on with your budget. You can manage a little better just by understanding how the count codes are put together. So. Um, glad to be back with you this week. So really the goal of this session, and the goal of all the sessions are really to help educate school leaders around school finance as we enter this period of budget cuts and as things start to restrict. And we'll kind of work through that as we go, but specifically these next eight sessions are designed to kind of help you with the FY27 budget process. And we understand that we're kind of into budgeting season. So if you've already done the budget for FY27, great. Maybe this will reinforce and support things that you've done already. If you're working towards the June board meeting as maybe your presentation, then hopefully we'll add some value to your final stages of preparation. And then also for those that do like I've done sometimes in the past, which is have the board approve the current budget to open the next year, and then we would formally adopt the budget in July or August, after we got some more solid data. Maybe we were discussing salaries and hadn't really determined a final salary schedule, whatever the case might be. And wherever you are in the process, hopefully this will add some value as you work through your FY27 budget. So the reason I mention the budget here is because really, whether you're approving a finalized FY27 budget or you're just approving the FY26 budget to start next year, the reason you have to have an approved budget is because the statute says you have to have authority to spend the first dollar. So on July 1, in order to spend money out of a fund, you need to have authorized a budget that allows you to spend that. So a quick review of last week, and a mention here that these are recorded, so you can go back and watch if you miss one. We know we're missing some folks this week that are at the MOASBO conference. Excellent conference for learning. But we talked about the why, what it is that we believe is going to cause the restrictions in budget and what that's going to impact school districts as we move forward. We really dove into the revenue side, which I think is the critical piece of beginning your budget, because you really can't start divvying up the money until you know how much you have. And so talk through some of the processes for estimating your revenues. Then we spent some time on reserves and really talking about um, districts with healthy reserves are great. And if you're going to spend down those in this time of some tightening of the budget, you really need to have a long range plan, and you need to have the board on board with what that plan is. So today we're going to talk about fund structure and the account code nomenclature. And you might think, well, that's really an accounting function, but I can tell you, if you understand at least a um, limited amount of understanding of the account code structure, it will help you as you analyze things, as you ask questions about can we spend here. So hopefully it will give you a little bit of insight into the different pieces. So the key concepts hopefully will come away with are budgeting for Fund 4, that coding matters, project codes for budgeting, how those impact when you set up your budgets, and then using the ASBR for reference. And you're gonna hear me a lot during these sessions talk about the ASBR. So I would encourage you to get familiar with how to get to the ASBR, learn about the different sections of the ASBR, and at some point in time, whether it be these sessions or next year when we do them, we'll really have some more intensive look at the ASBR and its value. Most of you are aware the fund structure, starting at the bottom, capital projects. Fund three is the debt service. So any GO bonds, your principal interest fees are going to be paid out of that. Fund two is only going to be certified wages and benefits. And then I leave fund one because that's basically everything else that's not in those other funds. Some districts will have proprietary funds that are numbered outside of 1 through 4. I work with one district that uses their activity funds are set up as for them, it's Fund 60. But ultimately, what they're doing is they're accounting for student activities in a separate fund so they can match them up. You'll see it sometimes with food service, also with scholarships. Um, some accounting software is the one I used most of my career. You can actually go in and set up activity accounts. And so you match a project code between the expenditure and the revenue, and they're accounted for in Fund One. Others, uh, you set up a separate code. Some districts will have a separate bank account for those proprietary funds, but ultimately understand that there's 4 funds on the ASBR. And so those proprietary funds ultimately roll up into Fund One for the ASBR. Typically, the first number in the account code is your fund. Some examples are 001, that's a SysFin code, 011. Some districts, like I said, I've used 10. And they, for that particular district, they have 10, 20, 30, 40, and 60, but it's really 1, 2, 3, and 4. So part of the reason we talk about this is, and as we're building towards the budget, this is the statute you can go back to, or you can go to the accounting manual, but these are the pieces of the budget that are required each year. And so part of that is understanding in item 2 there, sorting it by fund and source. So when you're talking about revenues, you're going to need at a minimum level your local, county, state, federal sources going down, and going across, you're going to need it split by the 4 funds. And then when you get down into expenditures, you need to understand fund, activity, object, some of those things. So that's the actual statutory language for what your budget needs. All right, I'm going to start with Fund 4 because when I was always working with budgets, I always felt like I had to understand what, if anything, I was going to have to move out of operations to support Fund 4. So in other words, if I know I've got these expenditures, I'm limited on how I can get money into Fund 4, then I need to account for, am I going to need to make $1 million transfer? Can I get by with a $250,000 transfer this year? But that was money that I was immediately going to deduct from what I had in operations. So I always started with Fund 4. This is a very simple spreadsheet um, where I went back. It's historical, so you can get an idea of what your district has spent. This actually goes all the way back to 2001. But essentially, what I've done at the top was I took my beginning balance, my revenues, anything I was transferring in, what I was going to spend out of Fund 4 to come up with an ending balance. And I needed to project this out because you're not just planning for this year, you're kind of planning for future years when you're talking about Fund 4. But this is helpful to understand what you need transfer wise in order to maintain at least a zero balance in Fund 4, which is a requirement. In the expense part down here, you can see I just summarized it by the different capital project payments. So any object code with a 6.5 is going to be a capital project item. So you got buildings, improvement to site, equipment, and then you get into the 6600s, which are your lease purchase payments that come out of Fund 4. So account for those, determine what you need to go into Fund 4. Uh, Basically, used to account for facility acquisition, construction, lease purchase, principal and interest payments, and other capital outlay expenditures. And that's directly from the accounting manual. And you'll notice I have bolded the lease purchase principal. What you need to understand related to this is there's a difference between a lease, which you are just renting, and the property will not stay with the district when it's over. That is an operating expense. If you are going to acquire it, own it at the end, even if there's a minimal payoff. So let's say it's a dollar buyout at the end, it's still considered a purchase. So if it's a lease purchase and you're going to own it, you have to make those payments, principal and interest, out of Fund 4. And those can be significant. So understanding where they go and how to account for them is important. This is kind of a Fund 4 analysis of what is included and what is not included. There's always fuzzy areas when it says ordinary repairs, um, painting, some of those type of things, because really when you're talking about Fund 4, when you're talking about capitalizing an asset, you're looking at two things: dollar amount and useful life. And it's a lot of, I'll show you some policies here from one of my former districts that talks about amount of capitalized expenditure. So if it's a $5,000 threshold and it has a life of more than a year, you would consider that a capital item. And recently, I think MSBA 3 or 4 years ago came out with some different policies that raised that threshold from 3,000 to 5,000. But essentially, if it's something that has high value and has a longer life, it's going to be a capital item. So this is a policy at this district policy. It's an administrative procedure policy, but all expenditures related to lease purchase agreements shall be considered expenditures for capital outlay. And then it defines equipment as tangible personal property, da 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 da, acquisition cost of $5,000 or more, and useful life of 1 year. And again, that's an administrative policy, inventory management. So that I encourage you to look at your policy for what has to be capitalized, what needs to be paid out of Fund 4. And then there's some tricky items. Let's say you have a lease purchase agreement of $50,000 for $250 Chromebooks. Well, the Chromebook itself, the $250, does not meet the dollar threshold, but the statute says that lease purchase agreements should be capitalized. So what I would suggest that you do in situations like those are look at your policy, talk to your auditor, ensure what's been consistent. How have you previously treated that in your district? And then just document your rationale, whether whether you decide to pay for it out of operations or whether you decide to pay for it out of Fund 4. Make sure that you've documented your rationale, who you talked to, what advice you got, and move forward that way. So the challenge is once you determine the expenditures, how am I going to get money in there? So let's say you have a $200,000 lease purchase payment that is going to come out of Fund 4. Well, you have to know, how am I going to get money in there to pay for that? So the only time Fund 4 is really considered operating is when you set your levy. And you can set your operating levy with some of that money going into Fund 4. However, your minimum operating levy has to be 275 in order to receive state aid. So if you are a district that rolls back to 270 or is below 275 and use Amendment 2 to come up to 275, you do not have the option to put any operating money into fund, any of your levy into Fund 4. If you have a $4 levy, then you would have some leeway to place some of that levy into Fund 4. The other way to get it in there is either by placement of fund or revenue sources that allow for placement to Fund 4 or by making transfers. So we talked last time about the revenue pieces and what can be placed where, but I'm gonna review a couple here. Um, Classroom Trust Fund, just keep in mind that whatever is above the 0910 amount has to go into Fund 2. So you need to go back and look at what you got in Classroom Trust Fund in 2009-10. And if you're receiving more than that now, the excess has to go into Fund 2, but everything up to that amount could be placed into Fund 4. As far as revenues or transfers go, this is off of your ASB or off of an ASBR. And on the very first page of the ASBR, you can go in and see what transfers are allowed. And you actually put those in. So if you have transportation costs, you buy a bus. That is a transfer that can directly be made with no limits. If you buy capitalized food service items, you buy a new warmer, you buy a new stove, those are items can be a 100% transfer from operations to capital. And then your calculation for the maximum amount of transfer that can be made just without any rationale other than it's authorized is you can do the maximum of $162,326 or 7% times the SAT times your district's weighted ADA. And that will determine the maximum transfer that you can make to Fund 4. So transfers are a significant way to get revenue into Fund 4 as well. So what's the practical application? I would create a Fund 4 projection that takes you out 5 to 10 years. I strongly encourage you to develop a preventative maintenance long-range plan, and I'll show you an example here in just a second. And then lease purchase debt ultimately takes money away from operations. So when you're considering how to pay for things, and you're talking about lease purchase debt versus GO bond debt, just understand that there is no direct funding source for lease purchase debt, whereas GO bond debt has the funding source of your local taxpayers. So when you issue lease purchase debt, it is coming out of operations, although it's being paid from Fund 4. So this is just a quick little sample of we did a roof analysis and we determined that these were the over the course of the next I forget this I think this went out to 2035 or 6, but these were projected costs of replacing these different pieces of roof in different places. We had one for HVAC units. We actually inventoried all of them with age and size and determined a plan for replacing those doors, asphalt. Then you have other miscellaneous things, your gym floors, turf. And so getting it on a schedule allows you and the board and future administrations to see these are the things that we've planned for that we need to keep current. Because especially, well, in any district, but your taxpayers typically paid for the asset the first time. What are you doing to plan to maintain it, to take care of it, so that you're not going back to them for things that are broken down because you didn't take care of them. And again, this is not for new items. This is for preventative, taking care of the things you have. All right, moving on to Fund 3. Fund 3 is really the simplest of all funds to budget for because you're going to have to make your levy calculation. So that's going to determine your revenue source, the majority of it. And then it's just a matter of determining, working with your bond counsel or your underwriters to determine what's the principal, interest, and fees for my typically September, October, and March or April payments for the year, making sure that you have that covered. And the one tricky thing, and I've linked it here, but it's actually a link to the article that I wrote. I can't remember when I wrote it. But it goes into detail about how to account for intercept funds because as I've worked with districts and even in my own infancy in working in the superintendent position, this always a little bit confusing for me is how to account for those intercept funds. And so there's a link here to help you with that. So it's important when you to understand the levy setting process and what it means. When you we do a tax rate setting workshop, Jason and I do, and I would encourage you to come to that if you're new and want to learn about in more detail. But in essence, Fund 3 is its own entity. In fact, that's why we've been encouraging people to talk to your legislators about not applying Hancock to Fund 3. What happens in Fund 3 is you are allowed, and this is kind of a synopsis, a nutshell. You're allowed to have 2 years of needed resources in Fund 3. So if you have $10 in your account, and the next year is going to cost 8 and the following year is going to cost 7, that's $15. You have 10 in your account, you can add 5 with this year's taxes. So whatever your assessed valuation is times a levy to create $5, that is how the levy is set. So in other words, you're taking your current balance, you're adding to it whatever will cover this year and next year, and that's how you set your levy. If that levy, let's say you're currently at 50 cents, that's what you're levying for Fund 3. If that calculation comes back at 60 cents, that means that you could levy 10 cents more and not be out of compliance. So in other words, that extra 10 cents would not put you over this year and next year's need. What most districts do in that scenario is they will dial it back to 50 cents because that's comfortable to cover. If it, let me preface this. If you're struggling to make your payments and it's 50 cents and you calculate 80, there may be a reason. You may have to raise it a little bit in order to cover this year's costs. But typically you'll see it a little bit more than what you're currently levying, and a lot of districts will roll it back because that's what they've told their taxpayers. The flip scenario is it's at 50 and it calculates at 45. Well, you don't have um, the authority to say, well, we're going to keep it at 50. If it's at 50 and it calculates at 45, you've got to go down to 45, or you've got to come up with a reason to keep it at 50. And so if you run that calculation, it's below your current levy. I would encourage you to immediately contact your bond agent and start having discussions. How do we prepay? What are some things we can do to keep our levy at 50 cents? But that's just a quick review of setting the debt service levy and wanting to keep it at a stable amount. Fund two, revenues are placed there basically from those revenue sources. We talked about basic formula, Prop C, and Classroom Trust Fund last week. I would add to that that fines, career ladder are required to go into Fund two, and then reimbursed matches. Real quickly, when you have a payment request from IDEA or federal programs, maybe it's a grant, and you have uh, certified wages and benefits, then when you receive those funds, whatever amount you charge them for wages and benefits of certified staff should be booked into Fund Two revenue. So if I'm paying for a certified teacher or staff member and their benefits, I'm sending it to a place for reimbursement, and maybe there's also some supplies and other operating materials in that request. When I receive that payment, I need to split what paid for the teachers into Fund Two, what paid for the supplies, purchase services into Fund One. So those are the basic manners with which you get revenues into Fund Two. The other way is to, let me go back. The other way is then at the end of the year or monthly. I've seen a few districts do it monthly. Most just kind of do it at the end of the year. But at the end of the year, Fund Two comes back negative. In other words, your Fund Two balance at the end of the year started at zero. You brought in $10, but you spent 15. I got a negative $5 balance at the end of the year. You make a transfer from Fund One to Fund Two for $5, and now you end the year in Fund Two with zero, which is really the target. So what expenditures come out of Fund Two are typically positions that require a DESE certificate. So you run into places where you have a certified teacher, but they're filling a position that does not require a DESE certificate, and that would be paid out of Fund One. Because the positions that are paid out of Fund Two are typically those that are required to have a DESE certificate. You can have a balance below zero. That's what I just talked about until year end. No fund is allowed to have a balance below zero at the end of the year. Preferably, you don't want a balance other than zero at the end of the year. There are some reasons for that. And if you do have it, or if your district has a specific need for keeping it above zero, then there may be some unique situations. But preferably Fund Two. Most of the time when you look at ASBRs, their Fund Two at the end of the year is zero. One of the things that's nice about Fund Two is it's relatively easy to fund or to track versus budget due to the sole purpose of the fund. So in other words, you're really only dealing with wages and benefits, and so you can sort and get to those funds pretty quickly, and you can look to see the school business is very cyclical. So if typically at the end of October, you are at 0.16% of your Fund Two spending, I would guess this year you should, or this coming year, when you look in October, you should be really close to that number as well. If you're significantly off, I would suggest doing some investigating, because that number should be really easy to track. There aren't many timing differences when it comes to Fund 2, typically paid on the same schedule every year. And then the most common transfer from 1 to 2. Fund 1, incidental fund, basically everything doesn't go into the others. Fund 1 and Fund 2 cumulatively are considered operating funds, and those two together are what you calculate your reserve percentage at the end of the year with. And that's what we talked about that last time. All right, I'll spend a little bit of time, and I'm gonna have to go fairly quickly, but and this is about as colorful a slide as you'll ever get from me. But I tried to make it to where you could see where the different fund, function, object, location, project code, and source code are these different colors. And then as what I was alluding to as far as how it helps you to be able to quickly identify something when you just by looking at the account code, I can look at this account code and tell that it's a Title I certified wage at an elementary building for supplemental instruction, and it was paid from the federal government by looking at the account code itself. So when you look at functions, the second grouping of funds or the code, anything that starts with a 1 is considered instructional. Anything that begins with a 2, 2000s are support services. And then anything that starts with a 3 is considered a community service. So 1111 is your elementary code, function code. 2122 is counseling. And 3512 would be early childhood, something that is serving the community. When we go to object codes, there's a set for revenue and there's an object code set for expenses. Your object codes will always start with 5, and the second digit will determine what the source of that was. So 5100 is local, 52 county, etc. And then on the object side, 61 is wages, but you can go a little bit deeper. Anything below 6150 is certified wages. Anything above 6150 is classified wages. And then you get into benefits, and you can sort benefits classified and certified by if it's in Fund 1 or Fund 2. If it's a Fund 2, 6200, it's a benefit related to a certified staff. Purchase services, supplies, anything we talked about this when we were talking about capital projects. If it has a 6-5 fund or object code, then it has to be in Fund 4. If you ever see an 001 something 6500 object code, it's in the wrong place. And then 6600 is how you account for debt. Location codes are important. If you have multiple elementary schools, there'll be 4,000, 20, 40, 60. And the thing you can do is you can go back to your core data screen 8 and look at your district data, and your building code in DESE will match or should match your accounting code in your software. So if we have 4220 is Smith Elementary, then in our accounting structure, anything with 4220 should relate to Smith Elementary. Here is an example. I just went into one of DESE's reports, and Columbia was the first one I came to with multiple schools. So you can see they're different high schools are 1050, 1060, and then you get into the middles, or the junior highs, middle, looks like they've got all their middles, either 20 or 30, maybe age bands, and then elementary schools. So the important thing about location codes is, I don't know, 5, 8 years ago, They made it mandatory to start splitting expenditures so that they could start seeing what the per pupil expenditure code was or amount was in buildings across a district. So they could look to see if Smith and Jones Elementary were getting approximately the same per pupil expenditures. In the accounting manual, you can go and look and determine, does this function code have to be split between locations? So this is just a shot of the E's. Early childhood, 3511, yes, it has to be split. The early childhood building lease or rental does not have to be split. And the reason for that is probably because it's for a specific building, and would not be needed to be split. Transportation, ECSE transportation does not have to be split, but ECSE instruction does. So that kind of helps you there. And it's important that you understand that when you start expending things that benefit all buildings across the district. So here's some help as far as how to split those expenditures by building. Direct placement, when it's specific to a building, then you can just place that whole expense there. We had somebody come and do some repair work on the floor, and it was for Smith Elementary. That's going to get coded to Smith Elementary. You can split by the denominator. So it was for students. So there were 200 students in Smith Elementary and 300 in Jones. So one of them's going to get 40%, one of them's going to get 60%. You can do it by teachers. You could do it by the square footage if it was something that was, servicing the building. So whatever, if there's a group of people going, or it's for all of the buildings, you can split it by the denominator. You can split it evenly if it's something that makes sense that everybody benefited the same, then you can split it evenly, or you can split it by the impact. You had two teachers from Jones go to this training, you had three from Smith, and you had five from somewhere else. Well, then those are the people that were impacted by the training, and you can split it that way. Whatever method you use, it should be reasonable in how you arrived at that, and then it should be consistent. So if I'm going to do it this way this time, I should do it the same way next time. All right, project and source codes. This is important for a number of reasons, um, but your local, county, state, and federal are pretty easy because when you get your DESI transmittal, it tells you what the revenue code is, and the first digit or the second digit in that revenue code will tell you what the source is. So it'll be 5311 for your state aid, which is the three is state, or it'll be 5451 for Title One, and the four will tell you that it's a federal fund. So that's pretty easy to get to. The project codes, and again, I've got a link here to the article I wrote about source and project codes. The project 5-digit code is really important. I think I didn't understand this early in my career. The first digit is the source, and it aligns with the revenue object code. So there's a method to the madness that they put this together with. So here's an example and why it's important. This is a special ed issue that I dealt with at my prior school. I deal with it with client schools, is the split between federal and local source in special ed. And special services project code locally, whether you fund it with local sources or whether you fund it with some of your state money, are 1200 to 10. And what you're looking at here is this is part of the accounting manual. It says this project code 12210, special ed paid with state or local fund, can come from a source of one, two, or three. So in theory, you could use your county source as well. The code for the IDA placement is 44100, and the revenue code for that is 5441. This is important for maintenance of effort. If you've had to deal with maintenance of effort issues, in other words, that you're continuing to use your own source of money to support this program, this split becomes very important. And the one of the key elements you're looking for is when I'm done with at the end of the year, when I run a report for 44100 project code, are all of them in source 4? And does that total match what I've done with EPEGs, with my payment request, with my budget? And so it's important. And this is important with IDEA, it's important with federal programs. Anything that has a federal source of funding, these need to match. Hopefully I'm driving that point home. But again, there's an article that shares the value of this. The other thing, there are source codes. Well, there's 99,000 source code available. So if you're wanting to track something in your district and you're wanting to be able to quickly run a report, how is this program doing? You can set up one of the allowable ranges of codes. Let's say it's 888, that's 5/8. You set up 5/8 for the revenue side, you set up 5/8 for all of the expenditures you're making, whether it's wages or supplies, and you can quickly run a report that pulls out all project codes 88888, and you can see if I was profitable, loss, did it meet my expectations. So it's good, it has good value there as well. So what's the practical application of all of this? This is the ASBR summary that comes at the end of the year when you finish your ASBR. It is also the budget summary that you need to have in your budget report. So when you complete your budget report, you're going to project this for the end of the FY27. You'll start with estimating your FY26 ending balances, what I've budgeted for revenues, if I'm making any transfers, what I've budgeted for expenditures, and here's what my ending fund balances will be in FY27. So that's why you have to understand which place they're going into, because this is what your budget summary will look like. Balancing revenues and expenses for programs with designated funding. That's the piece we just covered there when I was talking about maintenance of effort, matching, those type of things. Understanding your maintenance of effort basics, and then being able to focus on specifics of the budget based upon coding rules. So when you're putting together your budget, understanding that the functions on the left, objects or the funds on the top, and how that bills out and what that looks like as you put your budget together. Kelly, do we have any questions? That's pretty fast and
Dan,
furious.
Jim, we have one question from Dan. It says, just so I'm clear, the transportation calculation cost and the food service transfer to Fund 4 are in addition to and do not take away from the 162K or 7% transfer. So a bus and a milk cooler wouldn't wipe out an entire 162K transfer. Is that correct?
That is correct.
Okay, so equipment expenses, buses, new stoves, those kinds of things. That's in addition to that maximum transfer that's available to these folks.
Correct.
Okay. And then Teresa asked, when do you recommend making those adjustments to ensure no funds have a negative balance? So I think what she's asking is, when do you do your amendments? I guess, or to your budget. Do you? I think I've heard you say before you didn't wait till the end of the year, but you obviously have to do one at the end of the year.
Right.
Thoughts on that?
Yeah. So a couple of things. First of all, the question about amendments, the first time we really took a serious look at amendments was after the October payroll, because you had September, October, you had at least a couple of payrolls to look at how was the budget impacted. Then somewhere in early spring when we had our local taxes collected and we kind of had an idea, we'd look at amending then. As far as the transfers at the end of the year, uh, oftentimes that would just be something I would talk to the auditors about. Hey, we're going to end with a deficit in Fund Two. The auditors know that they're going to have to make a Fund One to Fund Two transfer to cover your certified wages in most cases. And they will ask you the same thing at the end of the year when we're talking about Fund Four, because they'll ask you, do you want to just be at zero? Do you want to be where you started the year, or do you need to have a little extra in there this year? And so they'll talk to you during the audit phase about how much you want to transfer to Fund Four. And that's really why you need to have a long range plan, because you don't want to just say, well, I don't know, transfer however much you think we need. If you have a plan, you can tell them, I need you to transfer X so that we have an ending balance of $50,000 or $500,000.
Hey, Jim, can I ask a follow-up question to that?
Sure.
So our auditor says that we have to have those transfers in the budget, like an estimate of them in our initial budget, because the um so um
Concur. Yeah, there's a difference between having, so in other words, um, you don't want to just go in with your budget to your board that says I'm going to have a negative 25,000 or whatever amount. You need to give your best estimate
okay.
when you make your budget. We think it's going to take 100,000 to get us to where we need to be, and you put that in your budget. Then when they come and talk to you, you might, who knows, maybe you had to do an extra roof repair or whatever, and the $100,000 didn't get you exactly to where you want to be at the end of the year. They would say, hey, we noticed in your budget you were wanting to end the year at 50 grand. Right now you're only at 35. Do you want to make that additional 15,000?
Okay. Okay.
Are there any other questions? We want to try to have time for questions, but there's a lot to this.
Hey, Kelly, I do have a question. Can you hear me all right?
Yes, sir.
Okay. Jim, can you explain to me? You had talked earlier about doing a transfer for transportation, and you said it's 100% of that cost. Can you explain why DESI then has a transportation transfer document that I look at each year? Is that just a recommendation?
Um, I'm not familiar with the exact document you're talking about.
It's right
Uh,
underneath the 7%. It'll say transportation transfer.
um, I'll have
Or
to.
maybe I've just been looking at the wrong thing, but if find
Yeah,
out, let me know.
yeah. I'll do a little digging to see what
Okay.
exactly you're referencing. And if you can, if you would shoot me an email,
Yeah.
and I'll dig into that a little bit because typically I don't know if that's a document that you have to create if you're going to make that transfer. I'll have to look at it.
Okay. I'll send it to
But
you.
I do know that they will allow that transfer.
Thank you.
Okay.
Jim, this is Landon Gray. I'm at Moesbo. I'm assuming he was just talking about on the where it talks about your full transfers that you can make, and
Uh-huh.
that they give you that full allocation of what the 100% would be the most you can transfer over. I think that's what he might be
Okay.
talking about.
Okay. Thank you. So they're just establishing based upon what you have submitted, maybe through your ASBR, they're backing in and saying this is the max transfer.
Yes.
Okay, that makes sense. They are doing. I will say it's good and bad. Early in my career, we could get by with maybe some miscodings that weren't really material. Now that is not an option. There's too much matching going on. They're very um, they have the ability to really drill down and make sure you're coding things the right way.
All right, Chelsea put in the chat. If you have any other questions, you can email us at tighttimes@mcsa.org, and we'll get those questions to Jim. I noticed that this week he did review kind of what we did last week. So if there are questions, he may hit on those in next week's review. Appreciate that. Appreciate Jim taking the time to do this, and appreciate all of you joining us. Please let us know, give us some feedback, and we want to make these very valuable to you. With that
Hey,
said,
Kelly,
thank you very
next
much.
time, yeah, next week be a good week because next week we're going to get into budgeting for personnel, and that's a big chunk of your budget.
Okay, great. Thank you, Jim. Thanks,
You bet.
everybody. Have a
Thank
great
you.
day.